Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on September 26th, 2022. A reminder, we have a trading session tomorrow at 11 o'clock. I'm going to go over the trades and results from a very light trading week because of the Fed meeting. And rates, recession, and earnings, oh my. Um, as you can see, very, very mild trading. Is that the best way to describe it? Because we had rolled trades out a couple of weeks in order to protect ourselves from any tumult that might happen in the market, which might include a sell-off plus a recovery. And now we're still seeing the sell-off parts even this morning. And we, really didn't generate a lot of cash or a lot of returns. But this is what you need to do. You need to avoid certain market events that you can't necessarily predict. You can't predict what the Fed was going to say, and you couldn't predict how the market was going to react to it. So last week we did sit, as I said, on the sidelines, and one of the things that I think people, especially those of you who are relatively new and haven't followed me or followed the market or followed both for a long period of time, is what happens is the Fed speaks and interest rates are announced. And the Fed then has language about interest rates and attitude of the Fed going forward. That first stop is the bond market. And when I was looking for my first house, interest rates were 17, 18%. So you say interest rates, mortgage rates at 6 and the federal funds rate at 3.25, what's the big deal? The big deal is the interest part of your mortgage has doubled in the last 2 years, last year, if you had not previously bought a house. And if you're in the bond market, this is the biggest bearish hit in terms of the absolute value of bonds, 44, 50 years, maybe forever. So you get tumult, you get concern, you get stuff going on in the bond market, and it spills over into interest rates. Now, one of the things that happened was the bond market then votes the way futures contracts go, and they have what they call the dot progression or the dot vector, or based on Fed comments. And there's a belief now that interest rates, the Fed funds rate, will go as high as 4.6%. And that again would be almost a 50% increase from now, which means more bad news for bonds and possibly softness for equities. There's also a concern that there would be a real recession now. And I've had this question in many of my live sessions and in emails. What do you think? And because the market hasn't reached a consensus on how fast and far interest rates will rise, that's only part of the equation. And as this slide repeats what I was just saying about the way the Fed announcement hits things, but the fourth bullet point here about Q3 earnings is now less than 3 weeks away. For us, it starts with Delta and the big Delta Airlines and the big banks. And now you will see the market focus. What will interest rates do to earnings? Short-term, mid-term, long-term, based on company announcements. So you have two things going on. First, three rates. Will the rates cause a recession, and then recession spill into earnings? So interest rates will continue to rise. And the following chart is interesting. This is a chart you can get yourself. It's a free newsletter from the Federal Reserve, and the big thing here is that the gauge that the Fed economists use, and it's a little hard to read, is called the underlying inflation gauge. And as long as that is turning down, that's good news, because the CPI can bounce around, especially if you include food and gasoline and wholesale prices. So what you're looking at is all three of the metrics that the Fed uses, and that's what they're going to focus on, plus a Fed survey, which is not here, on consumer sentiment about inflation. And consumer expectations for inflation are going down, mostly because the price of gas is going down. Where I lived, it was well over $4, and now it's $3.59. So getting back to possible recession, which of course spills into earnings and spills into prognostications about how a company will perform and spills into the overall market. We're in a statistical recession, and that negative GDP growth for a couple of quarters is statistical recession. Um, Companies' profit growth has slowed, has not turned negative. Housing's been hit, and I spoke almost by accident with a couple of developers, residential real estate in the Baltimore, Washington area this weekend. And the bottom line was, while it's a little bit harder for people to get money, there's still more demand than supply for new housing, especially for starter houses, which one of the two focuses on. And there's a shortage of starter housing around the United States that's new. And some interest rate companies will get hurt. We're going to find that out, and we'll see how the market reacts beginning in October. So I love the 451 Alliance. They bought ChangeWave a long time ago. It's where I worked for Dave Durham for 10 years and or 8, 9 years. And these are important numbers. And I know because we had light trading, I'm dwelling on sort of abstract stuff right now. But we will talk a little bit about trading before we conclude. Um, there's a structural problem in the U.S. labor force. And this is going to keep inflation higher than it normally would be, to the extent that we now have much more of a service economy than a manufacturing economy from 50 years ago. And service economy, of course, is highly sensitive to both labor participation rates and therefore wages. The one thing that isn't mentioned here is between COVID, the beginning with the Obama era, and then Trump and then Biden, the crackdown at the border has discouraged a lot of migrant labor, illegal migrant labor, or even legal migrant labor. And there was a lot of attrition and wreckage in the past 3 or 4 years in the Immigration Naturalization Service and the State Department that has really slowed up a lot of work visas, such as in the J-12 program. So the bottom line is there's a shortage of workers. There was just a piece this morning that manufacturing jobs are now a net surplus, 67,000, compared to where we were pre-pandemic. So how does that affect earnings? As I said, it starts with Delta. Expectations will be lower. And it's a 5-year average of 77% of companies beating expectations, and that shows that you're smart. You don't raise expectations too high. But there could be some very big surprises, in part due to these lower expectations, and we're going to try to find them. Speaking of which, one of the areas that we have to be very careful but very also involved in is retail. And as you can see from this clip from the 451 Alliance, and they do fabulous surveys. And I'll take some pride as 20 years ago, Dr. Paul Carton was then there at the Alliance at ChangeWave, and it was mostly business-to-business surveys, and we sat down and spoke about, we were yelling at each other for those of you who worked there at the time, but we were yelling at each other, and we finally convinced each other that we may be able to focus on consumers as well, and they started doing fabulous online consumer surveys, and they've just gotten better. So these numbers are important. Online shopping is not retreating to pre-pandemic levels. This means an entire cadre of department stores, Kohl's being the one that's in the headlines most, as Jim Cramer would say, have no reason to live. And it's going to hit the sector as a sector and put a cap on pricing for the sector, but they're going to be selected winners. And that's consumer-oriented products such as Crocs and consumer outlets, such as an Amazon. And we need to keep this in mind. So what does this mean? It means, how are we going to trade going forward? We're going to manage the open and core positions as usual. We're going to roll, generate cash, roll, generate cash, roll, generate cash. When we hit break even or modest profitability, we take a breath. We close the position for a week, 2 weeks, a month. And it's a trading tactic as opposed to something about the company and the stock, and then we get back in. We're going to be selling further out of the money puts with longer expirations, meaning not 4 days, but maybe 8, like we did on Friday. And when we hit our goals, we're going to close the roll to generate more cash, and we're going to be pretty religious about it. So here's an example, which is the trade we put on post-Fed on Friday. The trade is a company called Block, which used to be called Square. It's maintained the same symbol. The stock was above 55. We sold a 49 put. So it's more than 10% out of the money. And we got a very nice price for it. And it's because it's extremely volatile stock, not a volatile company. For those of you completely unfamiliar with it, if you haven't taken a taxi that takes a Square, or you haven't gone to a restaurant that takes Square, um, it's a payment processing company. It competes with the PayPals of the world, but it's PayPal is living off of legacy code and architecture that's trying to update. Square is not. It's been around far fewer years, and as an entire ecosystem for gig workers and small to medium sized business. They can do payroll, they can borrow money from Square, it's legally a bank. Uh, let's say normally there's 4 days or 3 days between the time XYZ Bakery processes a credit card and gets the money from the credit card company. If you're making payroll and you're short, you can borrow money from Square. And the point is, once you get into their ecosystem, you don't leave. They also have Square Cash, which is a Venmo competitor and just about the same size, I think. And uh, it's one of my favorite companies, but it can be a difficult stock to trade. And um, the bottom line for us was, well, the chart was scary, which you'll look at in a moment. It was fine for us because we're selling it out of the money. Put that was more than $6 out of the money. It was liquid enough to trade. It wasn't as liquid as I would prefer, but it was liquid enough. And we have a potential more than 1% in a week. And here's the chart. This is the 5-day chart. And you can see the gap down, and go to the charts yourself on your own computers because this can be a little hard to read in a static presentation. But you can see some stability. You can see volume comes in at the open, and then people make up their mind what to do. And there is, the green represents higher price, red lower price. And you can see there's more greens than reds by far because people like where the stock is trading now. 20-day chart says the same thing, that it's on a decline. It might scare a chartist away. Someone who doesn't look at a company or fundamentals or follow something for a year. Well, we followed it for 5 years. Might not consider it, but to me, that flattening out, also in the face of a difficult market, was a very good sign to start the trade. So we did, and let's see how it goes. So trading this week in particular, more trades like Square tomorrow, way out of the money puts. This time possibly with good until canceled orders, which I'll explain live if you haven't taken the training. More cash coming in from our rolls. We're going to be rolling our positions perhaps tomorrow, but probably starting on Wednesday for the core names, the names we've been in for a while. Keep that cash flow coming back. And I am now on what I call the hunt. Next couple of weeks, I've started this a couple of weeks ago. I'm looking for new names in defensive sectors such as biopharma, but also um, in sort of emerging areas, which is a part of the climate change, what I call ecosystem. And you can find fascinating companies. The question is, are they liquid enough and big enough for us to trade? There are no major market catalysts this week other than what's going on in Ukraine, and eyes are beginning to shift towards earnings. Last note, starting tomorrow, we start Income Madness. So if you're registered for the program, if you're in the master's program, you're part of the program. If you're not and you've purchased, you're in it, please manage your capital accordingly. It's 6 days of trading at noon. It's a lot of fun. 12 to 20 positions. We manage all trades via alert. But I want to repeat this because I know I've disappointed some people. We still use the fundamental approach we use in Options Income Blueprint and Master's Program. If a stock turns south and goes against us, we don't close it to free up capital the way you would do in a day trading system. So this is not traditional day trading, which I'm going to talk about in a moment. This is the Master's Program clustered trading, if you want to call it, for 6 days. And so if something turns south unexpectedly, bottom line is we'll stay in the position. So that's why I say manage your capital accordingly. And the next thing is the Millionaires Trading Club, where my opening session on the first day is about 1-day trading, which is different than day trading. And it's great. You get to hang out with your colleagues, which, and I'm not kidding, it may be more important than the little detail you may live here or the new approach I'll be discussing on a couple of my. It's all two of them. I'm doing 4 formal sessions plus all my office hours, which are one-on-one, and 2 of the sessions are completely brand new, and the other 2 sessions are modifications of what I've done over the years, but based on current market conditions, which means there's significant changes, and clarifying some breakthrough material presented last year on how to segment a portfolio. Um, and it's just great. And of course, it's not just me. There's Jeff Wood and Dave Durham and John Hutchinson. And other people will be there, and you'll learn from your colleagues. So I urge you to consider going. So with that, let me conclude, and I will see you tomorrow in live trading. This is Michael Schulman. Oh, also, for those of you who participate, this is Rosh Hashanah. First night was last night. So to everybody, Happy New Year and have a great bowl of chicken soup.